Welcome to the Jill on Money Show. It's Friday, September 6th. And yes, today is a very important day because there is a jobs report that will be due. And this is the last piece of big economic data before the Federal Reserve's meeting later this month in mid-September. So what are we expecting? Their estimates are all over the place, but let's say it's around 160, 170, maybe up to 175 or 80,000 jobs created in the month of August. So that would be up from the July reading. If you remember, the big freakout that occurred in the July report was that there were fewer jobs than expected, 114,000. The unemployment rate went up to 4.3%. That was a big deal. And now there's some consternation over these numbers in that perhaps Hurricane Beryl contributed to this weak reading. Maybe it could be reversed this month. But here's the bottom line. The job market is slowing down. And that's exactly what the Federal Reserve has wanted it to do. They want to see wage growth come down because when we make more money, when we have higher wages, we spend more money and we contribute to inflation. The inflation data recently have really shown a lot of progress. So I think we are on track to see the Federal Reserve cut interest rates by 0.25 percentage point. If this is a terrible, terrible report for August in the terms of the labor market, maybe they'd go by 0.5. I doubt it. It's a pretty conservative Fed. So anyway, we'll keep you updated on that if any of these data points come in differently than expected. For today, however, let's answer some emails. This is from Larry, who writes, how can I make my wife more comfortable putting money into a high-yield savings account? I would like to use Marcus by Goldman Sachs. The account would be linked to our main account. Her concern is that they have no walk-in branches. Oh, that's so interesting. You know what, gang? I get this. There are people who are used to a certain way of conducting their banking, and so going fully remote is kind of weird. So if you have Marcus by Goldman Sachs or any of these online accounts, there are no walk-in branches, there's no ATMs, there's nobody who's working there. So everything is electronic. Ask her, well, what are you walking into the branch to do? Is it really important to be able to do that? If she really is not comfortable doing everything electronically, maybe have just a small account with some money at a local branch that she could go into, where she could talk to somebody. I don't know. That might be enough for her. And let me know if you'd like to bring her on the air. We happily would help to ease her mind. That's part of what we do here, gang. We help ease your minds. And we do that by making sure that you remember to send us emails or come on the air with us. It's a lot easier when we can do this in person. Because I think, Larry, for me, it's easier to ask her questions like that than for you. Okay, Jean says, I was just notified that I may lose my job next May. And I have a 403B with my employer. Along with other life challenges, I'm trying to prepare myself for the last few months of employment. I have started an emergency fund. I have a second job, and I was thinking of opening a retirement account with Ally, which leaves me to ask, what should I do with my 403B when the job is over? I was going to open a Roth IRA today, maybe do a Roth rollover later. My next job is unsure as of now, but working hard towards a decision. Well, Jean, here are the 3 basic options that you generally have when it comes to an old retirement account. Number 1, you can leave the account where it is, as long as the employer allows it. And sometimes that's a great option because if you have a good plan with low fees, it can be pretty easy. You know what the deal is. You just log into your old account, no problem. Number 2, when you get your new job, you roll it into your new plan. But as you said, you don't have your new job yet, so maybe that's an option that could be delayed if you just keep your money in your 403B. And number 3 would be to roll it over directly into an IRA rollover if it is, or a traditional account if you have already used traditional assets in the 403B, or a Roth account if that money that you have put into the account is post-tax money. All of this is to say, none of those options is a bad option. They're all very good options. I do think the priority should be having that emergency fund built up. I would even say that that is more important than funding a Roth right now. You didn't mention how much money is in the account. You didn't mention how much money you have elsewhere. But again, if you just started an emergency reserve fund, we really would love you to have 6 to 12 months of your living expenses in that fund before you even open a Roth IRA. Okay, this is from Anonymous, who is writing with a question around a pre-tax strategy generally and an NQDC more specifically. Let me just translate for everybody there. That is a non non-qualified deferred compensation plan. And by the way, they sort of look a little bit like a 401k, but it is not a 401k. These workplace plans, they let you defer a portion of your salary into a separate account. So that's why it sort of feels like a 401k. You invest it in different investment options. However, it's like a longer term employment agreement between you and your boss. So you can defer a portion of your annual income until some specific time in the future, and it could be 5 or 10 years or in retirement. But again, it's usually used as an executive extra retirement benefit because you have more money to put aside than a 401k limit. And so, by the way, the tax gets paid when you have the distribution later. So you'll recognize it as taxable income later in the future. Anonymous writes, I am fortunate to make a high salary in a high cost of living area. I also have a special needs child, and that changes the game in terms of savings for the future. She will definitely need help from us for her life. I'm only recently able to itemize medical deductions for care for my daughter, since it is now above the 7.5% of my AGI threshold. But that assumes a significant pre-tax retirement strategy. I am 56, my wife is 54. Our combined salary is $425,000 plus bonus and stocks. The bonus is about $100,000. Stocks, it varies, but it has been about $150,000 a year. I have $1.1 million in a traditional 401k, $320,000 in a rollover IRA, and another 401k, $10,000 in an HSA, $150,000 in a brokerage emergency fund. We just started to use Roth 401k contributions. Thanks to you, it's about $10,000 and growing. I max out my 401k and catch up every year. My wife does not have access to retirement plans. Right now, I have $210,000 in non-qualified deferred comp plans. I'm contributing 15% of my base salary and 30% of the bonus to the plan. And I've got distributions that are set to deliver equally 1, 2, and 3 years after separation. I am worried that my job may not be safe for too long. I expect to keep the role for at least another year, hopefully longer. My pension, wow, he's got a pension too, would be $11,000 a month if I were to work another 2 years and take my pension at 62. It does not grow much beyond that if I'm not working there, so I know I'm very fortunate. I plan to keep working as long as I can, hopefully until age 67, although I do anticipate my next role will be less compensation. I had a serious health concern a few years ago, and I'm okay so far, but I worry that I may not be an oldie oldster. I own a vacation home in another state tax-friendly place. We rent for the main residence. The value of the house is around $800,000. The mortgage is 2.86%. We owe $380,000. We did stop paying down early thanks to your show. Here's my question. Should I continue to fund the non-qualified deferred comp and generally continue to plan to switch to full Roth 401k in future years? I was able to itemize last year due to the medical costs putting us over the threshold. Switching to the Roth may challenge that a bit. And if I stop the NQDC, it would definitely challenge my AGI because my AGI will go higher. But I know I need to do more post-tax savings. I've been advised to convert the $350,000 IRA if I have a break in work or education and income if the market goes down. Do you agree with this strategy? Okay, first of all, here's what I want to just say. For the next year, do exactly what you're doing. There's no reason to change anything. Don't do anything. I like the idea that if the break occurs in a year and it makes sense to start to slowly convert, then great. Do it. That's a great idea. And I think that it may be that converting might be the best idea for you guys because you have so much money in pre-tax assets. And I know you had your health scare, but your wife is only 54. It really would be nice for us to have that tax paid for way in advance, right, for her. But, I'm looking at kind of what you have, the million in the 401k. You basically have like $1.5 million bucks in a pre-tax environment and only about, looks like $150,000 in the brokerage emergency fund. So there's a couple of things to really consider. One is like, well, should I convert and soak up some of that brokerage emergency fund money, or should I just start to pull the money out of some of these pre-tax dollars out right now? And yeah, you could take the distributions, but I don't know if I would do that right away. I just want to see where you stand in a year. So here's what I really think. I think we should talk in a year. You should come on the program. I think do what you're doing right now for at least another year, because we just want to see how long this does last. And you don't have to put as much money into the non-qualified deferred comp. Maybe you can try to play with this a little bit just to beef up the non-retirement savings and investing a little bit. I do think that for this next year to get that extra tax benefit from the medical deductions, maybe it's important also to see like, well, what's this really worth? Am I spinning my wheels for small dollars versus a longer term impact of having this money available? Okay, so that's it. And thank you, Anonymous. Here's your cousin, Anonymous number 2. Question is, am I crazy to be investing in municipal bonds? I'm 53 years old. I'm married. I've got 2 kids in elementary school. Half of my net worth is in munis. And about, listen to this, $12.5 million, mostly in AAA Texas, so that's the municipality, long-term school bonds. And they earn an average of about 4.2%. That's amazing. The reason why I'm asking is that I don't know anyone else who invests in munis, and even the people I talk to at the brokerage firm don't know much about munis. And the brokerage's bond guy keeps telling me, how'd you find this great bond? It's making me a little nervous. The rest of my net worth is mostly in stocks, a heavy base of mega cap tech. We live relatively modestly. We'd like to make sure we have money for future generations. I love muni bonds, by the way. I really do. So let's just be clear about what is a municipal bond versus a regular taxable bond. So a municipal bond, it's like you're lending money to a state, in this case, Texas, or maybe it's New York City. It's usually used for people who are in a high tax bracket in a high tax state. And the interest income you receive would be exempt from federal taxes, state taxes, also local income taxes. And for that reason, since you're not paying any tax on the interest, usually municipal bonds actually pay less, have lower yields than taxable bonds. Now, I'm sure that when you talk to people and you say, wow, I've got a 4.2% bond, one question you may want to try to answer for yourself and for them is like, well, did I pay a premium for these bonds? In other words, you've got these bonds that are paying 4.2%. Did you buy them at a moment when Texas was issuing bonds at a very high interest rate? Or did you pay up for bonds that had a higher interest rate? Did you buy them at a discount? So I would be interested in learning a little bit more about the nature of the yield to the maturity. But generally speaking, if they're AAA rated, we don't think that Texas is going broke. I do think that this is a great strategy. I don't know how much other money you have, but if you had $12.5 million in Texas bonds and then yet another $12 or $15 million doing in other stuff, that's just fine. I think that would be fine with me. I'd love to talk to you on the air because I love municipal bonds. I live in a high tax state. I live in a high tax municipality, New York City, New York State. And so muni bonds can be really, really very powerful for people. Just remember that you've got to do a tax equivalent yield comparison between muni bonds and taxable bonds. That's on pretty much every company's website. Okay? This is from Evan, who writes, I'm 60 years old. My wife is 54. We plan to retire in 5 to 7 years. My wife is a teacher who earns $125,000 a year. I'm a loan officer. I make around $100,000 a year. We have about $800,000 in pre-tax IRAs and 401ks. My wife will get a pension of about $7,000 in 5 years, and my Social Security will be around $3,000. I think they mean per month, so $10,000 a month. Wow. Evan goes on to write that the problem we are struggling with is monthly cash flow. We own a home in Silicon Valley. It's worth about $1.9 million. We owe about $1.25 million. The rate is low on the first mortgage, but included in that total is $250,000 of home equity line of credit debt, and that debt is 8.5%. My solution is to sell the house and downsize to a condo. Do you see any other option, as my wife and I would prefer not to sell if possible? Well, this is a tough one. I mean, could you buy something with the proceeds and be in all cash? You live in a very high cost of living area. So if you have to go out and get another mortgage, maybe it's not going to work so well. The other question I have is, Would it be possible? This is not great, but it is a possibility. Could you take some loans against your 401ks and then maybe pay down some of this debt? I don't know if that's even going to work, and it certainly puts a lot of pressure on you guys, but I'd love to have you come on the air and talk with us further, because it's hard for me to know what is the alternative, because if you're going to sell, I don't know how much more the new place would cost, even if it were a condo, and what the cost would be to carry that condo. So get back in touch with us. I'd really like to hear more from you, Evan. Okay, last but not least, I just finished my wedding bonanza, and many of you wrote in about my conundrum about how much money to give in various weddings. Neil says that he agrees with Mark, a couple of $100 for the marriage of a child or a close friend. That's it. I did more than that, gang, but I didn't do the crazy amount. I didn't start thinking about 2,000 or anything like that, but I did more than a couple hundred. And I guess that those kids are lucky they invited us. So that's that. All right. That is it. That is the program. Thank you so much for joining us today. And we so appreciate you. We appreciate all of your questions. If you've got one, just go to jillonmoney.com and click the Contact Us button. It's so easy to do. Don't forget to let us know if you want to join us on the air live. Sign up for the free weekly newsletter. It comes out today, Fridays, every single Friday. Mark does a great job with that. You can also see the links to our YouTube show called Jill on Money, powered by The Compound. Subscribe to us on the Odyssey app or wherever you find your favorite podcasts. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and web king, and we are distributed by Odyssey. Please lift someone up, change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.